The potential for forecasting errors has never been greater. And I'm telling you, man, we're going to read this article. There's tons of tidbits in here. You got to understand. As you're making your own investing decisions and you're planning for the future, you just, first of all, remember, the whole economist profession exists to make astrologers look good, if that makes sense. Always remember that. Economists exist to make astrologists look good. On top of that, investment professionals exist to make economists look good. And so if A is greater than B and B is greater than C, then inherently A is greater than C, if that makes sense. All right, let's read this. What a wonderful piece by Leibowitz here. Was that his name? Michael Leibowitz. Yeah, Leibowitz. I just got a chuckle. All right. Neither bull nor bear, says Leibowitz. A deflationary hurricane is churning off the coast. At the same time, a massive warm front is surging towards us, threatening inflation like we haven't seen in 40 years. As if forecasting future economic conditions was not tricky enough, both systems are fueled in unpredictable ways by the convergence of historical amounts of monetary and fiscal stimulus. The two ominous and encroaching weather systems make economic and market forecasting extremely difficult. The most recent of this evidence came from BLS, Bureau of Labor Statistics, employment report. The consensus of economic forecasters missed the mark by almost 750,000. That's 3 times the average monthly growth pre-pandemic, and that's what they missed it by. Forecasters must also untangle global supply line problems and resulting shortages of many commodities and finished goods. Further, robust pent-up demand from the lifting of economic restrictions of the global pandemic significantly influences the economic climate. Despite such extraordinary circumstances, the level of confidence in economic and market forecasts is remarkably high, which is completely unwarranted. I'll never forget Pablo. There's a guy named, I'm just not going to say him. He's kind of well known in my business, and I don't like him. I just, my own personal stereotype, I get it, but I could tell he's a woke guy, and is there anything worse than a wealthy, white, woke guy from San Francisco who has never freaking shoveled his crap in his life? Oh, but he's well known in my business. About 10 years or so ago, I can't remember, 8 years, he published a report saying about Obama's budget or something like that. This is great. The economy is going to take off. And I remember I said, why? I mean, look, I'm not saying it is or not. I said, what makes you think that? He goes, the CBO reports that. I was like, dude. And I completely lost respect. I said, I cannot believe I've been following you, man. You think the CBO knows their head from the hole in the ground? The CBO is a Congressional Budget Office. And I couldn't believe it. And at that point, I recognized a lot of people in my business don't know freaking crap. It's crazy. I couldn't believe it. I said, you're literally listening to the CBO projections and using that with your clients? I couldn't believe it. Anyway, I completely lost respect for him, and he's still around, and I'm not going to say his name. All right, the butterfly effect. In 1963, Edward Lorenz, a meteorology professor from MIT, wrote a white paper called Deterministic Non-Periodic Flow. Doesn't get much more dude, if you're going to write freaking articles for the MIT and other educational institutions, at least get some clickbait headlines, for heaven's sake. Deterministic Non-Periodic Flow? Huh? What the hell is that? Years later, his theories became a core foundation of chaos theory. Per the MIT Technology Review, the essence of the work is that small changes can have large consequences. I tell you, I was talking to a guy yesterday, he and his wife. I said, look, man, if you spend $5,200 a month in retirement, your probability of success is X, 80%. So I think it was like 82%. If you spend $5,000 a month in retirement, your probability of success, and we use the right capital, goes like to 96. That's $200. I said the butterfly effect. A butterfly flapping his wings in Malaysia can lead to a tsunami in Hawaii. So that's kind of what the thought process is. And it's just $200 a month difference. It's only $2,400, but compounded over time, adjusted for inflation, that becomes a significant amount of saving that you're not going to have to spend, if that makes sense. Anyway, and this guy suggested that the flap of a butterfly's wings might ultimately cause a tornado. Yet Lorenz's own deterministic equations demonstrated how easily the dream of a perfect knowledge founders in reality. that the tiny change in a simulation matters so much showed by extension that the imprecision inherent in any human measurement could be magnified into wildly incorrect forecasts. The imprecision inherent in any human measurement could become magnified into wildly incorrect forecasts. Does that mean anything to you in terms of climate change, global warming? How a simple flap of a butterfly can change the environment attests to the difficulty in predicting the weather. Meteorologists are quick to describe their limitations and relatively poor level of confidence around longer-range forecasts. They understand the impossibility of calculating millions of variable factors affecting the weather. If only Michael Mann and the freaking Nazis in the climate change at NASA, James Hansen of the world, NOAA, if only they would freaking recognize the same, but they don't because they're so confident in their models. Who creates the models? Human beings. Human beings are not fallible. All right, during more typical economic and market conditions, prognosticators struggle with forecasts. For example, this graph right here shows how the Fed consistently overstates economic growth coming out of the last recession. So here's the actual growth right here, down here in the black, and here's what they project. This is a June 10th Federal Open Market Committee projection for 2010, 2011, 2012, their projections, and here's a real growth right here. They're always overestimating. I couldn't believe it. But CBO is over great. Like, dude, you freaking idiot. The following graph, courtesy of Deutsche Bank, highlights how Wall Street economists have consistently erred in their expectations for higher interest rates over the last 15 years. Average 12-month forecast error since 2003, 60 bips too high. I mean, we're talking 60 basis points. That's basically 0.6%. All right, so if we got a 10-year treasury that's trading at 1.6, that's basically 40-50% wrong. A monkey throwing darts could be better, as my man Michael Edison said in an earlier article I read here today. As the title of the next graph tells, markets have a long history of poor forecast. Yep. The markets have a long history of prematurely anticipating Fed rate hikes. Yep. Those at the Fed offer a good amount of confidence in predicting the pace of economic recovery. They appear highly confident that any spurt of inflation will be transitory. If wrong, they offer complete confidence in their unproven tools to halt inflation. But we know inflation is awful hard to arrest. Wall Street analysts shrug off record equity and bond market valuations with forecasts of growth and normality. Investors buying at such valuations must trust that the Fed and Wall Street are correct. Hold a second. Despite the evidence that the professional economic prognosticators are not good at their jobs, everyone seems assured of the future. The graph below shows money supply growth. I put this on my channel earlier today. And fiscal deficits are at the same level. The graph below shows money supply growth, and the fiscal deficits are at levels that are anything but ordinary. Are we to believe the effects and consequences of such extreme monetary and fiscal policy occurring concurrently are easy to predict? Under such unique circumstances, what kind of professional would fail to recognize the peril of such a claim? And here's annual M2% growth. Whoa, get out of here, you. I mean, look at that, up and down, up, but still, it's the freaking M2 money is going like a weed. Historically, where's the hyperinflation? So here's the 70s, right here. It's from 68, right there. That is the only hyperinflation we've ever had, right here. All right, well, the M2 money supply was going through the roof. Okay, in 1940, was to fight the war plus the war on poverty. There wasn't hyperinflation, not hyperinflation. It just certainly wasn't hyperinflation back here. The deflation. Nuts. Total government outlay spending as a percentage of GDP. Some guy posted, I said, okay, I mean, again, I always explain Japan. Japan has a larger current account balance than we do. That's literally his only argument about Japan having deflation. Okay, whatever. I mean, you look, man, you can't argue with people who... You can't argue with people who are so confident in their own ability to see the future. You just can't. So you say, okay, whatever. Now, I'll tell you, first up, I absolutely think deflation is coming. Will I be proven right? I have no idea, man. I have no idea. That's why you hedge against both sides, just in case. You always got to see, what if I'm wrong? What if I'm wrong? All right, so then we got U.S. federal deficit. Let's see here. Right, in the balanced budget. Republican Congress right there, 96 to 2000. Republican Congress took over the House in 94, and we balanced the budget, baby. And here's a deficit right here running at a surplus right there. And then deficits for as long as I can see, going back to the 60s, really. We've had deficits going back to the 60s. And yet, runaway inflation, not here. Despite a poor track record, the cocksure attitudes of leadership, economic and political, and blind confidence in them is perplexing given their poor track record. Consider a small sample of their dreadful forecast. Janet Yellen in 2017 stated, "Would I say there will never ever be another financial crisis? Probably that would be going too far, but I do think we're much safer, and I hope there won't be another one in our lifetimes, and I don't believe we will see one." Less than 3 years later, GDP fell over 9%. And no, not in a quarter. Not in a quarter. GDP fell 33% in a quarter, brother. In May of 2007, a year before the subprime crisis would bankrupt many financial institutions, Bernanke, helicopter Ben, said, "We do not expect significant spillovers from the subprime market to the rest of the economy." Alan Greenspan in 2000, "I believe that general growth in large financial institutions have occurred in the context of an underlying structure of markets in which many of the larger risks are dramatically, should I say, fully hedged," i.e. there's not going to be a big crisis. "We will not have any more crashes in our time," said John Maynard Keynes. And I actually wrote I put a thing in here that said, well, I'll just show you what I said. I said, let's see if anyone responded back to my comment. So Keynes said that in 1927. All right, 1927, John Maynard Keynes, who all the libs love. "We will not have any more crashes in our time," he said, John Maynard Keynes, in 1927. And I said, no one answered I said, weird how it's Irving Fisher who gets lambasted for his prediction that the markets were at sustainable levels in 1929. Yet everyone forgets Keynes' prediction. Yep, that's a nasty wasp right there. "There's no cause to worry," says Andrew Mellon. "The high tide of prosperity will continue." The point in highlighting blunders is not to shame the forecasters, instead to help readers understand that despite decades of experience, reams of data and information, and well sought-after educations, economists and market forecasters don't know their head from a hole in the ground. They, like everyone else, have little ability to forecast accurately. The rosy forecast may be right. The economy might continue to recover gradually. The recent spike in inflation may be transitory, and economic will assume prior trends. Unicorns may spew rainbows. However, there are excellent odds they'll once again be wrong. Lorenz stated, "Small changes have large effects. Now consider the potential range of effects from the plethora of economic and policy factors exerting significant influence over economic activity and human behavior." It's always about human behaviors. The reality is like meteorologists predicting next week's weather. No one knows what the economy holds in store. Of course, they can extrapolate current trends and make educated guesses on how consumers will react to future events, but no one has ever experienced anything like we face today. I could not agree more. And I'm telling you, man, I was talking to a guy today, and he had probably a little bit too much cash, but I don't very rarely do I say don't have a lot of cash. Having cash is always a good hedge against calamity. That's for sure. All right, love to hear your thoughts. We'll see you.